Good evening. My name is Shervin Joseph, and I'm with Fitzgerald Financial Division, a division of TowneBank Mortgage. Along with me is Sean Higgins from United One Resources, Senior VP. And tonight we're going to present to you Mortgage 101, answer all your questions, and we're going to present everything with regards to your credit score and credit. Now, this is a series of literacy that we're bringing to you again from TowneBank Mortgage and Fitzgerald Financial Group. We are elated to be here. I think, in not only because it's Black History Month, but because we believe with a passion that this is where we should be with regards to engaging with potential homeowners and showing people one of the biggest issues and fears is the process of home ownership and how do you get there and what do I do with my credit if I have some hiccups, or how do I overcome certain hurdles. Well, we hope to answer every single question tonight. So if you have a question, please feel free. So without further ado, I'm going to introduce Sean Higgins. He's going to give you a quick bio on himself. We've been doing this together for about 15 years, and he is amazing at what he does. So again, Sean Higgins, Senior VP with United One Resources.
Thanks, Shervin. Good afternoon, everybody. As Shervin said, I'm Sean Higgins from United One. I have a presentation on credit scoring, which I'll be going through in the next couple minutes. Just to set the stage, a couple of things I'd like to let everybody know right up front. We're not a credit repair clinic. We're a credit reporting agency that works with lenders. Actually, the lender is the best place to get access to your credit report and get a good understanding of what's actually on your credit file. So I have a bunch of slides I want to go through. And as Shervin set the table so well, I'd like to let everybody know my goal for being involved in this is to help people understand more about their credit score in hopes of putting people into houses, hopefully reaching someone tonight that maybe didn't understand the process and helping them along in their process. So I'm going to go ahead and put my presentation up on the screen and go through it. So there's my contact information, Sean Higgins, United One Resources. I'm based in Pennsylvania. I've been doing this for over 30 years. Been very fortunate to have a working relationship with Shervin for over 15 years as their company's provider of credit reporting services. So without further ado, let's get into the presentation, okay? So credit scoring, for those that don't understand it, credit scoring is one of the most significant factors that comes when getting a mortgage. A credit score is really a measure of the risk of default. And what that means is there's a score that ranges between 300 and 850. The higher the score, the better. And that's a score that's appended to your credit file as it stands at that moment in time. And it's used to measure the risk of default. In mortgage lending, we use a FICO score version 8. That score is appended to the three national credit bureaus that maintain a credit file on most of the consumers in the United States, which are TransUnion, Experian, and Equifax. So at that moment in time, when that credit report is accessed, it is scored. And when it's scored, it provides a good indication of the lender of the likelihood of repayment. Shervin will spend some more time during his presentation explaining the scores that are needed for mortgage approval. One of the terms that you'll hear me use quite a bit tonight is credit fitness. And credit fitness is a term that we like to use. It's really about making sure that consumers have a good awareness of what's going on with their credit file. There's a lot of different ways to get access to your credit file. I'm going to talk about that tonight. Once again, credit fitness, just a term to be aware of what's in your credit file. So let's go to the next screen. So as I said before, the scores range between 300 and 850. You'll see the nice little graph that's up on the screen. Anything above a 670 is considered to be a good score. Very good is 740 to 799 and over 800. We typically don't see many scores much over 825. Anybody that's much higher than that is really what we would call a statistical anomaly, meaning that there's very few of them out there. So in my role in this process is we provide the credit reports to the lender, and then we look for ways to improve the scores when there is a need. we have a credit score simulator that works very well, that can put together a plan for improvement, anywhere between 30 days and 90 days, up to as much as a year, depending on what's actually in the credit report. So scores can be improved. That's the most important thing to remember. Okay. So what actually makes up a credit score? So the good people at FICO put together this chart. And as you probably guessed, payment history is the biggest factor in your credit score. So if you're paying your bills on time, that'll have a very, very positive impact on your credit score. Amounts owed is the next biggest factor. And the biggest component of the amounts owed section is going to be the revolving credit or credit card accounts. If you could keep your credit card account balances in ratio to your available credit at a utilization of around 20%, that's going to maximize your score. The remaining three factors that have an impact on your credit score, the largest one obviously is going to be length of credit history, and then new credit and mix of credit. So when you look at your credit report score, you're going to see that the biggest driver of the score are going to be the payment history, and then also the amount of utilization on the revolving account balances. So where does it all start? It all starts with the credit inquiry. And then when you apply for credit, and the credit grantor gives a credit application, and you authorize that lender to actually make an inquiry on your credit file, that's considered to be a hard inquiry. Hard inquiries should only be posted to your account at your approval. A credit report is accessed with the consumer's approval, and then a score is appended, and the borrowing or lending process begins. The other type of inquiry that's out there is a soft inquiry. Soft inquiry is generally used in an existing account relationship. So if you have a credit card, chances are when you signed up for your credit card, there was a section in your agreement with the credit grantor that said they had the right to look at your credit report once a year or more frequently to get a good feel for what's going on with your financial history. Soft inquiries are also used in the selection process for pre-approved offers. So most of us see pre-approved offers of credit coming via the mail when you pull your mail at night, and that's how you have been selected. Your credit criteria, your credit report met the credit criteria that credit grantor had selected, and they make a pre-approved offer of credit. Soft inquiries, once again, not at your direction, but at your either fitting into a program or your relationship with an existing credit grantor. Hard credit inquiries are at your direction, and generally as part of the approval process through a credit application. Get a lot of questions about how much will a credit inquiry affect my score. Sometimes mortgage lenders will talk to a potential applicant about pulling their credit report, and there's some hesitancy about their credit score being impacted. The truth is if you make a mortgage application and you have a pretty good sized credit file, you can expect to see your credit score drop by about 5 points within the next 30 days as a result of that inquiry. Now, if you have a very, very thin credit file, not a lot of information on your credit report, that may have a little bit more of an impact on 5. But the thing to remember in this section is I would probably not be too concerned about a credit inquiry driving your credit score down. Once again, 5 points 30 days later. Now, FICO also tells us that if someone's out there making a large number of inquiries on their credit report, for instance, the example they cite is if you have 6 inquiries or more in the course of a year, you're going to be 8 times more likely to declare bankruptcy than someone without any credit inquiries. And the reason is they believe that someone that has that large number of credit inquiries is probably shopping for lifelines, trying to get more credit to help them out of a tougher situation. So that's the only time that I've seen where that may have a negative impact, and it's probably someone that was in a little bit of a jam to begin with. Okay. So FICO scores. How do you improve your FICO score? It's a lot of common sense issues. Pay your bills on time. Keep your balances low. And you should probably only apply for and open new credit accounts as it's needed. Okay. Credit fitness. There's that term again. Everybody in America is allowed to get a copy of their credit report weekly through annualcreditreport.com. It's a website that's it's hosted by the government, and the three credit reporting agencies, Experian, Equifax, and TransUnion, they allow access weekly because of COVID through 2023. When you do go to annualcreditreport.com and you do want to get access to your credit report, just keep in mind there's going to be some challenge questions to ensure that it's truly you that's seeking access to your credit report. An example of a challenge question might be, in 2012, you had a car loan with ABC Bank. What was the monthly payment? Or did you live at this address in the last 10 years? Fairly simple, provided that it's truly you and not an identity theft trying to happen. What are the top 5 things that drive your credit report score down? Any recent lates, any derogatory trades, high balances on unsecured debt, unpaid or recent public record information, and a lack of open trade. So as I said before, we do a lot of credit rescoring, not credit repair, but credit rescoring with our lenders. And I looked at a credit report just today with a coworker of Shervin's at Fitzgerald Financial. And there was a trade line that the utilization was 101%, which meant that the consumer had a $10,000 credit limit and they had about a $10,100 balance. Once we simulate that balance down below $2,000, that consumer was able to pick up about 50 points on their credit score. So timing has a lot to do with it, but quite honestly, the balances are what really going to drive the credit scores down if the utilization is very high, as I just described. Okay. How do you increase your credit score? You want to negotiate with creditors. The best example I could give that is if you had let's say you had a Macy's card and you had a one-time late and you had a significant relationship with them in terms of time, let's say 5+ years, and it was the only time. Chances are that if you had that one late and it was truly just a one-time late, maybe an error, maybe just an oversight, whatever you want to call it, if you call and you ask for a one-time courtesy removal, they'll give it to you. The store cards are very, very good at doing that. The Visa, MasterCard, Discover, and so on, they're going to be a little bit tougher and less forgiving on that, but they are going to be willing to work with you if it was a one-time situation. If you happen to have a collection account on your credit report, keep in mind that collection agencies or sales agents, they're in the sales business as well. They're trying to sell, the ability for you to repay is really what it comes down to. So we always advise consumers that when they're negotiating with the collection agency, that they should probably try to negotiate a settlement in which they will actually, meaning the collection agency will actually remove the trade line in exchange for payment. The revolving debt, as I said before, if you keep that balance below 20% of the credit limit, that's going to have a very positive impact on your credit score. We see a lot of student loan payments that are marked late. And quite honestly, there's a lot of student loans that are in deferment right now, and they could be being reported late due to some issues with paperwork with the servicers. Once again, come back to that credit fitness term. If you're looking at your credit report regularly and you notice that that's late, you should probably contact your student loan servicer and supply proof of the status to remove the lates. If you have an installment loans are scheduled repayment time. The payments are generally the same and the period is definable. That has very little impact on the credit score. So if you wanted to pay off an installment loan sooner with the hopes of improving your credit score, it's just not there. We always advise people to just pay them to the term as agreed, and maybe use that money for some other items that may be more pressing that would have a better impact in improving your credit score. So it seems that 1 of every 2 Americans or 1 of every 3 Americans, somewhere in between, has a Credit Karma account, I should say. And the scores are different. And this causes a lot of confusion because Credit Karma is a great example of credit fitness, understanding what's going on. But when you apply for a mortgage, they use a completely different score. So Credit Karma uses a score called the Vantage score, which is the word advantage without the AD in front of it, Vantage. Whereas in mortgage, presently we use FICO score version 8, okay? The mortgage industry does not accept the Credit Karma score presently. The score ranges are the same. The credit reporting agencies that are being scored on the FICO version 8 are all three: Experian, Equifax, and TransUnion. And Credit Karma only uses 2 of the 3 files. The score factors are different. As I said earlier in the slides, the FICO score is very specific. Those are your percentages. And the Credit Karma score uses terms such as highly influential, moderately influential, and less influential. Credit Karma, once again, great tool for credit fitness, understanding what's going on. You need to be aware that the score on Credit Karma is probably about 30 points higher than the score on the FICO version 8. It can create confusion at the time of mortgage application, but if you're working with the great mortgage lenders such as Shervin, they're going to be able to explain away that difference and show you how the scores are calculated differently and clear up any confusion and point you in the right direction. It's a common question. A couple other items of interest in credit scoring. Experian Boost has a very aggressive marketing campaign that's often on TV. Experian Boost is a tool within the Experian credit file. Once again, Experian is one of the 3 credit reporting agencies that is used to improve your Experian score. However, for the FICO score version 8, Experian Boost is not considered. Okay, so a couple of things to remember about Experian Boost is obviously it's only reported to Experian. It's a self-reported trade line. So what Experian does is you sign an agreement with them and they tap into your checking account every month and they take the payment information that's running through your checking account. Typically, it's going to be your utility bills. It's going to be your cell phone bill. And we've even seen Netflix accounts because that's a recurring charge. It can present an issue in mortgage underwriting. And when it does, we always advise our mortgage lenders to talk to their consumers and have the consumers opt out of their Experian Boost account, and the trade lines will fall off immediately. So Experian Boost, for someone that has a thin credit file and they maybe want to get a cell phone or they want to get a utility connection, something like that, this allows them to show a consistency of payment, but it's not going to help in the mortgage process. A little bit over a year ago, we started seeing some information out there that rental information was going to have an impact in mortgage lending. Well, the truth is it always has. Mortgage lending will always consider the rentals. There's a lot of verification of rents that are done in there. It's a great way to show proof of a consistent payment habit. However, the rental payments are not considered in the credit score calculation. So there was a misnomer out there that said you can improve your credit scores by contributing your rental information. Well, the truth of the matter is it's very important in the mortgage process, but it's not considered in the credit score. Once again, we're talking all credit scores on this side of the presentation, and the rental information just doesn't make it in there. Medical collections, this is a big deal. So in July of last year, the 3 credit reporting agencies made a decision that they were not going to continue to report paid medical collections on credit reports. A paid medical collection on a credit report could have an impact of as much as 50 to 70 points decrease in a credit score. Quite honestly, it did not belong on that credit report because that trade line should have never been reported, number one. And once it was paid, it should have been removed. So the credit bureaus have made the change, and it's been a very, very positive thing. The time for medical collection to be reported on a credit report, unpaid medical collection, increased from 6 months to a year last year. And during this year, a medical collection cannot be reported on a credit report unless the balance due is in excess of $500. So that's a big deal because there was a lot of consumer credit reports with $62 dental or medical bills that were impacting the credit score. And quite honestly, the biggest reason sometimes for an account ending up in a medical collection bureau had to do with maybe a miscommunication with an insurance or just a whole host of reasons. But that's been a very, very positive thing. So medical collections, not as big of an impact on credit scores as it was. We see generally 50 to 70 point increase in credit scores just based on that change. To sum everything up, there's some good information out there that's available for the consumer The credit bureaus each have a website, Experian, Equifax, and TransUnion. They have an 800 number. I've been working with these people for over 30 years. They're very, very concerned about accuracy in the product that they deliver. The best way to get accuracy out of their product is to talk to consumers, and they're very, very concerned about that. Annualcreditreport.com, I've already discussed. That's a great place to get your credit report. And the final one is a website that I try to tell as many consumers about as I possibly can. It's called optoutprescreen.com. And what that'll do is that'll stop the pre-approved offers of credit from coming to your mail. And it'll also eliminate what we call a trigger lead, which someone will start calling you after you've applied for credit, which is, quite honestly, it's a little bit of an invasion of your privacy. Most consumers are sharp enough that they can get their hands on credit through various different means, whether it's your bank or whatever it may be. There's enough sources of available credit that are out there. And this opt-out pre-screen will prevent the offers from coming. And quite honestly, the offers that come in the mail, you got to watch somebody doesn't grab your mail and take your identity. We see that monthly where people have been impacted on that, and we try to help them out of it. It's a great preventative measure. That is essentially my presentation. I'd be glad to answer any questions, either in the chat or through my email or my telephone number, the same. But I'm going to turn it back over to Shervin.
All right, thanks, Sean. It's outstanding as usual. That's a great presentation. A couple of notes there. Sean had said right from the outset, this is not a credit repair. This is an entity that works with us and other lenders to help the consumer with regards to updating their score, getting things resolved. So the money that you're spending, in most cases, I'm not saying that there's no place for credit repair. However, what I am saying is the money that you're spending, whether it's $1,000, $2,000, $3,000, that money could go towards the debt that you're trying to resolve. And Sean also stated that he has his entity, his company, the United One Resources, has a simulator. And if we see that once we pull your credit report, the first thing I do from a lending standpoint, after I pull your report, if your score is low, if there's outstanding debt on there, like collections or charge-offs, I'm pulling a credit simulator to see exactly what needs to be done to increase your score and to eliminate the bad debt that's on there. And what that does, it's allowing me to send you a snapshot, a blueprint of what needs to be done, which you're getting purely a true path to what needs to be done and what needs to be cleaned up from a lending standpoint and an underwriting standpoint. This is not something that you could rely on, I'm sure, with the credit repair entities out there. I'm sure that there's some that will take care of you. I'm not a big fan because it costs the consumer unnecessary money. Everything that they're doing, you could do yourself and save yourself a boatload of money. With regards to the rentals that Sean mentioned, the rental is always been and will always be, as Sean said, a factor in developing your ability to pay. Similar to a mortgage, it's your rent. So it's not going to be on your credit report. But what we will do, and we do this on every consumer, is we'll send out a verification of rental to see how you've been paying, or the 12 months canceled checks also could suffice. So anyway, just wanted to add some clarity. And I have to say that we're going to take questions from you throughout my presentation. So if there's something that Sean had mentioned in his presentation or something that I mentioned, we're not waiting for a Q&A. Please ask your question. We're accustomed to doing this. So I will tell you that any question that goes unanswered, is on you, because this is a great opportunity for you to get all your questions answered. So how did we get here? We're here because the U.S. Census Bureau has said that recently their stats show that 75% of white buyers own homes. Okay, that's the home ownership gap. Black are 44%. So the disparity there, we're here to try and help close that disparity, because that's just plain unacceptable. And the biggest issue I saw, and Sean as well, because we've been doing this together for about 15 years, and we wouldn't be here if our companies wasn't all in to try and contribute in some way to assist Blacks in gaining home ownership. One of the things that we look at is, well, what do we have to overcome? And literacy and the process is the big deal. That's the fear that most borrowers have. Borrowers fear their credit being a non-starter for them, because they're not sure. They might have had some hiccups. They might have had bad credit in the past, and they fear not being able to receive an approval. Well, there's only one way to find that out, and you have to make the first move, take that step, have a leap of faith. But this is not just faith, these are facts. You contact us, and we're going to tell you the truth. We're very candid, we're going to be precise, and we're going to give you a blueprint, a pathway to what you have to do to get to home ownership. The other is the fear of assets. We're going to talk about some grant programs in my Mortgage 101 tonight. And the other is just not knowing the process, not understanding the process. So tonight is an option for you to understand the process. And if you have any questions, whether it's tonight or anytime in the future, you're welcome to contact me. I'm available at 571-278-8351. Again, I'm with Fitzgerald Financial Group, a division of TowneBank Mortgage. And just as a note, TowneBank Mortgage, as of February of last year, was named by Forbes Bank the 9th performing bank out of about 5,000 banks in this country. So we're not chopped liver. Right? You could research us and so forth. So without further ado, I'd like to get started, and let's start talking. How do you get to the mortgage? So Mortgage 101, we want to talk about loans tailored for your needs. And what better way to do that than to have personalized service, a concierge? Well, I would be your concierge. You're not seeing anybody else. You're talking with me. You could you could go on my website and do a loan application, or you could call me and I'll take the loan application, because I'll have questions as I take the application. And those questions are just to help you. We are very aggressive as far as competitive rates are concerned, and nobody closes you faster. I don't want to say no one, but I do know for a fact around the Beltway, other entities have raised their procedures to meet our benchmark in closing. Whether it's in 10 days, 2 weeks, or 3 weeks, we could close you as quickly as you could help us close you. In other words, help me help you. And if you get me all the documents that we're asking for, everything in a timely manner, we would be able to get you closed in as quick as 10 days, which we do all the time. So if you're thinking of buying a home, you compare the options. Why are you renting? Why are you paying somebody else's mortgage? Why are you not taking a tax deduction? You have no privacy. Your rent is going to go up on an annual basis, and you're limited to the ability to personalize your space. Because understand this, Whoever mortgage you're paying, if you're renting a house or if you're renting an apartment, you have to leave that place just the way you found it. So you can't really personalize that space because it's not yours. So if you own, you build your own equity. You get to claim tax deduction. There's zero down payment loans. Now, there are only two, and I will discuss them, but there are grant programs out there to help you get to home ownership. And you could customize your home and make it truly a home, not just a property that you're renting. And they're fixed rate options. I only deal in fixed rate options, by the way, because I think that the market is still great enough to where you could get a great and decent fixed rate and not have to worry about your payment fluctuating. Now, are you ready to buy? Do you have a steady income? Do you pay bills, including your rent, on time? Do you have any money in your savings? Do you have the ability to make the mortgage payments? Do you have okay to good credit? All of that said, the very first thing you should do after asking yourself those questions is to speak to a loan officer. And obviously, the preference would be myself. I've been in the business over 36 years. I've held just about every position in origination of loans, whether it's loan officer, branch manager, area manager, division manager, and I currently hold diversity outreach manager along with being a mortgage loan officer. So, the realistic pursuit, these are the issues that you could conquer just by seeing me and getting pre-qualified. Realistic pursuit of properties. No realtor is going to take you to look at properties, and you shouldn't be window shopping. This is not Fifth Avenue. This is buying a home. So you should know how much home that you qualify for. You strengthen your buying power. You understand the difference between what you qualify for and what you can really afford. Understand loan programs and how to use them to leverage your purchase. Review your credit for accuracy beforehand so we can get you all squared away, clean up anything that needs to be cleaned up, and know that you could obtain a yes or when rather than a no. Understanding the difference between what you qualify for and what you can really afford. Just because you qualify for something on paper doesn't mean that it's what you really afford. Don't forget that you will have bills associated with your new home that you didn't have before. So qualifying factors, the 4 C's: capacity, credit, capital, and collateral. Income, capacity to repay the debt based on your earnings and employment history, expenses and number of dependents and other obligations you have. Credit, history of how much you owe, how often you borrow, if you pay your bills on time, and if you're living within your means. Assets, capital, or the amount of cash you have for down payment and settlement costs, as well as cash reserves to deal with repair or replacement expenses that may arise after you're in the home. Property, collateral to protect the lender's investment if you can't repay the loan. The home you buy must be worth enough to back your loan. So what factors affect your monthly payment? Rates, interest rates. You're hearing about the fluctuation right now of interest rate due to inflation. I'm here to tell you it's still a great market, and it's all predicated on your credit. Interest rates are mostly predicated on your credit. So you ask the lender for their current mortgage rates. Interest rates change daily and can change throughout the day depending on the market volatility. Ask the lender when you could lock in a rate to avoid increases in your payment. Typically, this can be done at the time you have a ratified contract. Once you have a ratified contract, we could get you locked in, and there's certain periods that you could lock your rate in. Make sure your lock on your interest rate is locked in until the day you close your loan. That's critical because you don't want it expiring and then you have to pay for an extension. Origination points or discount points are fees paid to the lender for the loan or can be linked to the interest rate. Usually, the more discount points you pay, the lower the rate. Ask for examples of payments with discount points and without. This will give you a better idea of whether you're paying discount points or beneficial or not. I can tell you unequivocally, I don't charge discount points. I like to give people a 0-point loan. Now, there's an option if you like to buy down the rate and you want to pay the extra points to do that. But usually we're aggressive enough and we have great enough rates that we could give you a 0-point rate. So down payments and mortgage insurance. A lot of youngsters particularly have asked me, we were on my podcast, we were having a discussion about that. 20% down. You don't need 20% down to purchase a home. You could purchase a home with as little as 3% or 3.5% down. And there are two instances where you have zero money down. And as I told you previously, I will discuss those as we proceed through the process, as we get through the process. Now, some lenders require 20% of the purchase price as down payment to avoid private mortgage insurance. That is pretty much, it covers the lender against anything happening to the property on a conventional loan. Okay. But on a conventional loan, you still have the option of putting down 3%, 5%, or more. But there will be private mortgage insurance to protect the lender against anything happening to the property. Now, there are government loans such as FHA and rural development loans, which will have mortgage insurance, no matter the down payment. Now, with FHA, regardless of your down payment, 20%, 30%, there's mandatory mortgage insurance protection. And you'll notice that the name is pretty much the same as conventional, which is private mortgage insurance. With rural housing development, it's a little kind of a guarantee, and you don't even feel the payment. It's like just about below $100 on a monthly basis in your payment. Most lenders have options to buy out mortgage insurance no matter what the down payment is on a conventional loan. This may increase your interest rate, but in the end will result in a lower monthly payment. So down the road, after your mortgage insurance isn't due because you've appreciated 20% or 22% equity in your house, the mortgage insurance automatically will drop off, and you would have to apply to get that waived or released. Or you could refinance and get that taken off if there's enough equity in the property. The other part of the principal and interest, taxes, and insurance, which is your mortgage payment, is the homeowner's insurance and property taxes. Lenders will typically require these items to be included in your monthly mortgage payment. These payments are deposited into an account at the mortgage company called an escrow. So when comparing monthly payments with different lenders, ask if the payment includes monthly taxes and insurance costs in the payment. The payment should consist of principal and interest, real estate, property taxes, and homeowners insurance and private mortgage insurance if applicable. So which mortgage is right for you? So as I said, conventional, you have about 3% down. You have to have pretty good credit to get a conventional loan. FHA is a government loan. It's a Federal Housing Administration, and the minimum down is 3.5%. It's a great option for first-time home buyers, flexible on credit, flexible on the qualifying ratios. I always suggest if you don't have 20% down, you want to go with an FHA loan. And side note and a fact, FHA rates are usually 3/4 of a point to 1% lower than conventional. So you have flexibility in credit, you have a little bit more aggressive price, and you have 3.5% down payment. Now, renovation loans, uh, it's a purchase loan with cost of rehabilitation to those loans is included in the rehab process. I think, and this is just strictly my opinion, I think you should have some experience with home ownership before you get into a rehab loan or what an FHA 203K loan is also a rehab loan. There's conventional rehab loans and there's FHA 203K loans. Now, earlier we said the rural home is a USDA loan, and this is one of your 100% loans. A rural loan, you're not necessarily in a rural area, but it will be on the outlying areas of wherever the suburbs are. So, if just to give you an example, if you're around the Beltway here in the DC Beltway, if you're looking to be in Brandywine, Upper Marlboro, Accokeek, Waldorf, those are just examples for where you could find those homes. And it's not a subdivision. You would have to ask your realtor what homes qualify for 100% financing, and they will know which home is USDA. Or you could call me and I could go online and look it up and tell you, yes, this home is approved USDA and will require no down payment. So just think of this for a second. If your realtor is, and if you have a great realtor, they'll be able to negotiate this for you if the seller is willing. And if the seller is willing to pay closing costs, and if you didn't have a down payment, you could actually walk into that house with no money down. Great loan. We do those. I do a lot of those loans. Just a great product. VA loans, 100% financing is the other 100% loan. By the way, I'm a veteran, former Marine, so I know everything about VA loans, and I take it very seriously because I like to make sure that my veteran brothers and sisters are taken care of. So you will qualify if you served any active duty or limited running active duty. We'll see what you qualify for, whether you're reservist or just an active duty veteran. You will qualify for no money down. And the mortgage insurance is not really mortgage insurance. It's called a VA funding fee, which is financed into the loan, and it's over the life of the loan, so you really don't feel it. Great loan if you've served your country and you want to buy a house. Just a great opportunity. So regardless of what anyone tells you, there are only two true 100% loans, USDA and VA. Anything else, there are wrinkles to it, whether it's the rate, whether it's money you're paying, or they have something built in and you're paying an astronomical rate. But VA and USDA is the true 100% loans. And so we discussed conventional as little as 3% down, competitive rates, 30 to 15-year mortgages, 20% down if you want to avoid mortgage insurance. FHA, we just discussed that, 3.5% down. And you could get a gift for your down payment from a relative, mother, father, sister, brother, could give you a gift for your down payment. And you could also, the seller could pay up to 6% in closing, although I don't think you'll need the full 6%. It works out to be more like 4.5% to 5%. There's a little bit of flexibility on the debt ratios. So, and the credit is a little bit more flexible with FHA. VA loans, no money down. It allows active duty reservists, veterans, and some surviving spouses an opportunity to purchase a home with zero down and zero monthly mortgage insurance. Just a great instrument for a loan, particularly if you've served. You need to take advantage of it. USDA guaranteed rural housing, helping borrowers achieve the American dream with zero down payment and minimal investment. 101% financing for qualified to moderate incomes. This is income qualified, folks, but as I just said, moderate income families. So we'll qualify you to make sure you qualify for that. Most folks that are low to moderate income will qualify for a USDA loan. It's ideal for borrowers with little or no cash, a no money down requirement. Loan limits are based on the area's eligibility, low upfront fee and low monthly mortgage insurance to be reduced based on principal balance. There's a little flexibility on your debt ratio, not as much as FHA, but there are a little flexibility, and credit requirements are reasonable. So, grant funds, we were talking about money down 3.5%. And when I started off, I prefaced our conversation with saying you really need to not fear not having the funds to close. Well, grant funds are available. Now, I'm just going to run through these. In Maryland, you have the MMP First Time Advantage, which will give you 3, 4, and 5%. Folks, this is it offers you an interest rate on the first mortgage and will defer and a deferred no interest second loan equal to the 3%, 4%, or 5%. If the funds exceed down payment and closing costs, then the remainder could be applied to the principal. The second loan is paid off when the loan is refinanced or sold at zero interest. Now, eligible borrowers must qualify for the MMP loan. For example, income limitations, credit score, and purchase price limits are taken into consideration. But this is a great program. It's a running program. I do a lot of these loans. If you're qualified, we will close this loan still in less than 30 days. And I've done them in 3 weeks because, good buyers, and they got their stuff together and they had to close. We got them in there. It's a great instrument. And then there's the MMP. Again, this is the state of Maryland, First Time Advantage that will also no interest second. They'll give you up to $6,000. So these all pretty much saying the same thing. There's a Smart Buy program, state of Maryland. So when it comes time, you could, and we're looking at your qualifications, we'll decide which, if you need it, and assets is taken into consideration, income is taken into consideration. So again, it's for low to moderate income. DC Open Doors is available for DC. FHLB options. We do FHLB. I could tell you that the FHLB is now at $12,000 for assistance, and community partners, which are firefighters, law enforcement officers, state accredited school employee, healthcare, educators, first responders, active duty military. Now they'll get up to $15,000. Virginia Housing also has a program. So there's enough grants around the Beltway to assist you if you qualify for them. And again, there's, strict qualifications with regards to that. They're dead stops on certain, on income, credit, and so forth. Student loans. How do we determine student loan payments for a loan qualifying? So I'm going to be very brief on this because, not brief, but I'm going to streamline it because it could get a little tedious. It used to be that if you had a student loan, lenders had to put 1% of your balance as your monthly payment. So if we looked at your credit report and everything was deferred, we had to put 1%. The great news is in the last 5 years, it's gone to 0.5%. So, 0.50 of your balance, which is great. And it will help more people qualify that have student loans. And just about anyone that's gone to college has student loans. The student loans have a payment reporting on the credit report of 0. You may use a payment equal to 0.50 of the loan balance to qualify. If a payment amount used to qualify is less than the monthly reported on the borrower credit report, the lender must obtain written documentation of the actual monthly payment status, and evidence of the outstanding balance and terms from the student loan creditor or servicer. Income-based repayment plans are acceptable. It used to be it had to be amortized over a period of time, and they would not accept income-based program repayment. However, if you have your documentation from your student loan entity and it shows that you're on an income-based repayment plan, we have to use the payment on the income-based documentation that or agreement that you have with your student loan entity. And I could tell you that's great news for the consumer. So, and the same thing is applicable for VA conventional and USDA. We have the same 0.50, or if you have documentation showing it's less than, we could use the less than as well. So I'm not covering anything on the credit score because you just had one of the best people in the business go over your FICO score and anything credit. So that's the whole purpose of having him here, because he's the best at what he does. So we come to the home buying don'ts. And this is something that everybody really needs to heed, because realtors, processors, loan officers all go through this with customers. So I have made this part of my presentation a long time ago to incorporate this so that way people understand that this cannot be done. Number one, do not change jobs, become self-employed, or quit your job while you're in the process. If you're, have an offer to get another job and it's paying more money, you call a loan officer and discuss it with him. If you're talking with me and it's quite evident that you're going to make more money, I would tell you to proceed, but understand that we have to verify it. We're going to need 2 pay stubs, particularly your first pay stub showing that you're actually making the money. The offer letter will get you an approval, but we'll need a pay stub so you could close. So that's a decision you have to make if you want to do that during the process. Number 2, do not buy a car, truck, or van. I can't tell you how many people feel that they have to buy, the really nice car to put in the garage in a house that they don't own yet. Don't do that. Those payments could send your debt ratio into not qualifying. Do not use charge cards excessively or let your accounts fall behind. What people need to understand that just about every lender in the country will do a soft pull on your credit report before you close to make sure that there are no additional debts, or even an underwriter has software where they could pull to see if there's anything that's not on the original application that we should be aware of. So You're receiving notice now. Don't do it. Do not spend money you have set aside for closing. Do not go to Cabo or the Bahamas and have a good time on a 4-day weekend with your closing money. Okay, that's you've saved up enough funds to close on a house. You have your dream laying in front of you. Don't blow it on a weekend of fun in the sun and then come back trying to figure out how you're going to get money to close. It's not worth it. Do not omit debts or liabilities from your loan application. Do not buy furniture. Wait until you have the keys to your house and you've closed on your house. That's when you buy the furniture. Do not originate any inquiries on your credit card. Any inquiries that you have on your credit report, and when we pull a soft pull, if there's inquiries, if an underwriter runs any software and there's inquiries, they're going to want to know what it's about. We want a statement. If there's a statement credit card, you have to explain all of this stuff, and it could put you in jeopardy of not qualifying for the mortgage. Number 8, do not make large deposits without first checking with your loan officer. Any large deposit, any deposit in excess of $500 has to be explained. We have federal laws that we have to comply with, and it is critical that you explain what 500, 1,000, 2,000. So you just can't, say somebody paid you back. Then you have to do a paper trail of everything. Everything with a mortgage, particularly where banking is concerned, paper trails will cover you. So the best thing to do is not to make any large deposits to your account. Do not change bank accounts or move money between accounts. The first thing, one of the first items we're going to ask for is bank statements. And it's the last 2 months' bank statements, and that'll tell the history. So you don't really need to move money or do anything, because we're going to have all your bank statements and we could see where the money's coming from and going to. And lastly, number 10, do not co-sign a loan for anyone. I know relatives will always lean on you, particularly if you're doing well. Hey, I really need this car. I need you to co-sign with me. Look, after you get your house, and you have to be selfish at some point, you've saved, you've scrapped and bought all this money together, finally to purchase a home. The one thing you don't want to do is co-sign anyone and not be able to get the home. So, with all of that said, those are the home buying don'ts. If you have any questions, please ask. We're here for the whole purpose of answering any question that you have. You're more than welcome to contact me at shervin.joseph@fitzgeraldfinancial.net, or myself, 571-278-8351. And we thank you. We thank you for the opportunity to present this to you. Next week, on the 14th, on Tuesday, we're going to talk to you about grants and be a little bit more detail about all the grant loans, VA loans, and USDA loans, and get a little bit more in depth in credit. So I look forward to seeing you next week. Until then, take care. Thanks, Sean.
Thanks, Shervin. Great job.
Thank you, sir.